Hello everyone, welcome to our Egyptian online seminar group. First, keep your microphones off. Then if you have any questions, you can ask our speaker after her presentation or during her presentation. I have great pleasure of welcoming Professor Christine Botosan, a board member at Financial Accounting Standard Board, FASB, and the past president of the American Accounting Association, Professor Anna Tarca, International Accounting Standards Board, member at Ifrs Foundations, Dr. Shannon Garavaglia, the Post-Doctoral Fellow at the Financial Accounting Standard Board, FASB. Now we will start our seminar with Professor Christine Post.
Thanks, Mohamed. I'm actually going to kick us off. Today, our talk is going to focus on the relationship between academic research and standard setting. And as was mentioned, we have Christine Botosan from the FASB and Ann Tarca from the IASB joining us today. Because of that, I wanted to just give the caveat up front that the views expressed in this presentation are those of the presenter. Official positions of the FASB, IASB, and IFRS Foundation are reached only after extensive due process and deliberations. Today, we're going to start off by giving a brief background of why standard setting and accounting research matter, as well as touch on how the FASB and IASB incorporate research into their processes. Then I'll move into a brief discussion of the post-implementation review process before we take a detailed dive into the current PIR projects and questions of interest related to the new revenue, leases, and financial instrument standards. Throughout the presentation, we'll have slides with a Q&A, so we'll stop for Q&A breaks at that time, and you're welcome to either chat in your questions, or as mentioned, you can unmute yourself to ask your questions of our presenters. So let's start with why accounting standard setting matters. You may have seen this infographic before, but if not, it does a really nice job of summarizing the role of accounting standards in society, and that is to take economic activity and convert it into useful information that can be used to make decisions that ultimately lead to a more prosperous society. And that's really in line with the mission of the FASB and the IASB, which is to create accounting standards that ultimately yield decision-useful information to users of the financial statements. And that's how the standard setters help to benefit society. But the Academy is also an important piece of that puzzle, and that's by providing useful information to standard setters in the form of academic research, which ultimately benefits society. And so, in other words, as accounting researchers, we're allowed to provide an important input into the standard setting process that yields better accounting standards, which ultimately help society. And that's, as an accounting researcher, I think one of the most important things we look for with our research, right? It's something that can provide useful information to someone other than just other academics. And standard setters are really looking for helpful research that helps them to make better standards. Diving into the post-implementation review process, I wanted to start with a high-level overview of the standard setting process broadly and how academic research fits into the standard setting process. So the first step in developing a new standard or revising an existing standard is defining the problem. And this is a crucial part. It's about figuring out what the scope of the problem is to make sure that whatever solution we come up with addresses the problem at hand rather than addressing maybe another important problem, but not the problem of interest. And accounting research contributes along all steps. So in this first step, when we think about defining the problem, accounting research can help standard setters to better understand what issues might exist in practice by providing large sample or causal evidence of why a problem might happen. Next, we look to identify alternatives that can potentially provide a solution to that problem. And at this stage, the staff at both the FASB and the IASB do extensive outreach with users, preparers, auditors, all forms of stakeholders to help understand what alternatives there are, but they also turn to accounting research to better understand what alternatives exist and what might help best fix the problem. This is also part of gathering and evaluating evidence. So here again, the staff are conducting outreach with stakeholders, and they're also looking at academic research to help understand which alternatives might best solve the problem. And this is all brought to the boards so that they can ultimately reach a conclusion about which solution is the best for the problem. Next, the board seeks to articulate and document the rationale behind the new standard or the update to the existing standard. And again, here, they use the research that they've done throughout this process, which includes relying on academic evidence to articulate the reason behind the decision that they've made. And last, we reach the post-implementation review process, which is going to be the focus of our talk today. And this happens after new standards have been issued or updated. We look to understand, has the standard met its stated objective? And again, academic research is a crucial part of this because it provides large sample and/or causal evidence that helps to better understand whether the standard is meeting its stated objective. Talking a little bit more specifically about the objectives of the post-implementation review process, the primary objective is to determine whether a standard is accomplishing its stated purpose. And this is what Christine and Anne are going to focus their talk on, is these sub-questions we have here, which are: first, has the standard resolved the issues underlying its need? So if you think back to that standard setting process, we look back at what was the initial question that we set out to solve, and have we addressed that through the standard that's been issued? Next, we try to determine, has the standard provided decision useful information? So throughout the process, as I mentioned, there's extensive outreach to understand what information would be used and how it would be used. But until we actually have real world evidence of how that information is being provided, we can't fully understand if we've successfully addressed the problem. Next, we look at whether the standard is operational. Again, extensive outreach with preparers, auditors, to make sure that we have the best chance at an operational standard. But once it's issued, there might be things that come up that we didn't expect, or that are bigger problems than we realized as we were going through the standard setting process. And so research can help us to better understand whether or not the standard is operational. And the last two bullet points deal with unexpected or unanticipated consequences. So have any significant unexpected changes to financial reporting or operating practices happened as a result of the standard? Or have there been any significant unanticipated consequences as a result of the standard? And again, we think about these things as we go through the standard setting process, but at the end of the day, until a standard has been issued and implemented, we can't understand what unanticipated things might happen as a result. In addition, the post-implementation review process seeks to evaluate implementation and continuing compliance costs. That's an important part of the cost-benefit analysis that goes into issuing a standard, is understanding what costs will happen as a result of implementing and complying with the standard. And we want to make sure that those costs aren't significantly greater than we anticipated going into the process. And last, broadly, the PIR process provides feedback to improve the standard setting process. This happens both through additions to or updates to the standards that have been issued, but also by thinking about future standards, better understanding the standard setting process and what changes might be made in the future. For example, we'll talk a little bit about transition. So this is one thing where research might be able to tell us something about how the transition was or was not successful, and then standard setters are allowed to use that information going forward to make future transitions more successful. We're focusing today on the PIR projects that the FASB has and the IASB have open. So the FASB has currently 3 PIR projects open. The first is on revenue, or topic 606. The second is on leases, or topic 842. And the third is on credit losses, or topic 326. The IASB has 2 open PIRs, the first on financial instruments, classification and measurement, and the second is on IFRS 10, 11, and 12. The IASB also intends to undertake post-implementation reviews of their new revenue and leases standards. Now, we're focused on the PIR process in our presentation today because of the upcoming Accounting for an Ever-Changing World conference. This joint conference of the FASB, IASB, and the Accounting Review, as well as the AAA, will happen in November of 2022 in New York City. And we've included the link here in the slides for more information specifically about the conference. Now, this conference is going to focus on research related to the FASB and IASB PIR projects on the 3 standards I mentioned on the previous slide, which are credit losses, leases, and revenue. And the goal of this conference is to create more relevant research that will help in the PIR process for these standards with standard setters. And not only this, but a nice benefit for academics is that papers that are submitted to the conference will be considered for publication in the Accounting Review. With that, I'm going to open it up for our first chance for questions. We have the FASB frequently survey or interview practitioners to get answers. How do these types of research differ from academic research? And that's a great question. I'll go ahead and answer that one just from the position of the postdoctoral fellow at the FASB. So I frequently help our staff with the questions that they put out to practitioners to get answers related to these things. But at the end of the day, they're only able to talk to the people who are willing to talk to them. And so that's one of the key limitations. And it's why a lot of what they have is ultimately just anecdotal evidence, because they aren't able to gather large sample evidence in the same way that we as accounting researchers are. Not only this, but they're not all trained in the same way that we are. We have a really unique set of skills as academics, and we're trained to think about how bias might creep into our processes and think about how we can ask questions in the best way to get the best kind of feedback. And so that brings a unique edge to what we do and provides really helpful and useful information to the standard setters in the form of academic research. I'm not sure, Anne or Christine, if there's anything you want to add.
Shannon, I'll also add that academic research is grounded in theory, and so it's built up on a whole body of literature that's come before. So research questions and hypotheses get set with all that in mind. And I think that's another strength that adds to the academic research, in addition to the things you've already mentioned, Shannon. Thank you.
Yeah, and the only other thing I'll add is that the type of outreach that we do is by its nature qualitative, and does have some of the limitations that Shannon described relative to qualitative research that is done in the academic domain. But we don't have the ability to do large sample empirical studies and well-controlled empirical, archival, experimental, behavioral type of research. We just don't have that skill set or the access to the data sets or the participants that academics have access to. And so that additional large sample type analysis is very useful to us to augment the kind of research that we do internally.
Yeah, I think those are both great points. And just to build on what Anne said, the theory part is a huge component of it, because oftentimes the staff will look to things that are closely related, but not exactly the question of interest, by looking at the theory and thinking about whether or not it would generalize to the issue that they're working on. I see we have a hand up from Steve Salterio. Steve, do you want to go ahead and unmute yourself and ask your question?
I'm glad that you're talking about the PRI projects today, because I did a mini review of them back in 2017. And so I have to admit my knowledge about your process is 4 years old, and I don't know if it's substantially changed or not. But as of 4 years ago in 2017, as far as I could tell of the various PRIs that were done, up to that point in time, only one specifically commissioned academic researchers to actually create a synthesis of what the research had said on the effectiveness of the standard. And that's, and I'm afraid I might pronounce Jennifer Bloat's name wrong, but it was Bloat and Robinson, and they got a nice little publication out of it as well. And then in trying to find other examples, I struck out in 2017. And when I read Bloat and Robinson, I sort of found that, you know, they were not cheerleaders for the standard. They reported both the good things that had occurred because of the standard and some challenges that were unanticipated. That's in contrast to most of the other PRI reports that are shall we say, almost cheerleaders for the standard setters, at least the ones that I read up to 2017. And so I'm wondering if this initiative here is a commitment to FASB and the IFRS Foundation to actually do more of these formal academic studies on the post-implementation of standards, similar to what Bolton Robertson did, because I think that that sort of study might be highly informative to standard setters, with the recognition that they're going to get, of course, the classic, well, this worked well, but this didn't seem to work so well. And it's not going to be an unqualified endorsement of whatever the standard says. And so I'm looking to see if this is an intention going forward to have more of the type of work like Bolton Robinson did. And once again, Jennifer, if you're right there, I apologize for mispronouncing your name.
I can start a little bit to respond to some of what you said, and then I'm sure Christine and Anne will add on. But I think it's not only always been, but always will be standard setters' intentions to understand both the good and bad of the standards. And that's something we've tried to emphasize in advertising for this conference, is that we want to know it all. And that's why we talk about unanticipated consequences. They want to know what didn't work so that they have a chance to address it. And speaking to a little bit of your point about the differences since 2017. So at the FASB, things have changed where the PIR process is now much more closely tied to the issuance of the standard. And it's done so that changes can continue to be made throughout the process that help to smooth the implementation process, help to get the information out there that users need. Before, there used to be a little bit more of a delay, which Christine maybe can speak to more because I don't know exactly what the details were. But now the goal is certainly to have that process happening closer to the issuance of the standard and to use this kind of input to understand what is, and most importantly, what is not working well.
Yeah, I can just build on, excuse me, on those changes that Shannon was referring to. So the process up until about a year ago was housed within the foundation, and the foundation would conduct the post-implementation review several years, many years after the standard had been implemented, sometimes up to a decade. There were some advantages to that approach. One of the advantages being that it gave plenty of time for the dust to settle, for people to learn how to use the new information, for companies to learn how to deal with any issues that they were managing through the implementation process. And it was a good chance to have a look back at all of the academic research that had accumulated over that time period, and to understand sort of, now that the dust is well and settled, where are we with respect to the information that's being produced and the cost of producing that information. And that process often did include a literature review. I can't speak to, all of the post-implementation reviews that the foundation did over that time period. But I worked on the segment project, and actually prior to joining the board was with Mary Stanford, the academics that were hired by the FASB to do the lit review for the segment project. I also know that there was one done for the look back at income taxes. So like I said, there were advantages to that approach, but there were also disadvantages, because it meant that analysis waited quite a while, and the standard setting response wasn't as nimble as we felt that it should be. So we decided, the foundation essentially asked us to take the post-implementation review process under the FASB with the oversight continuing of the foundation, and to start that process much earlier in the process of the standard being applied. So we actually go through review continuously as soon as the standard is issued, sort of following on all the work that's been done to the point of getting the standard issued. Well, then through implementation, monitoring implementation, and then finally, going into post-implementation review as soon as the standard goes effective. And then taking what we're learning from that process to decide, well, should we make immediate changes to the standard? Is that necessary? Should we wait and see kind of how things unfold? And so the advantage of that, I think, is that we can be more nimble and responsive and more timely in those responses. But it also means that sometimes there are issues where you kind of, I have to say, as a standard setter, I'll sit back and think, well, do we need to let the dust settle a little bit and let people get up the learning curve before we start immediately responding to, well, do we need to start, changing things? So there is a balance there that needs to be struck. The other thing that I think that has changed from an academic research perspective is that now we're looking for research in real time, as opposed to waiting for all the research to be done and then say, okay, now let's do a lit review. What can we learn from the research? And so I think it has changed that relationship between post-implementation and academic research. And that's why we're doing the conference, because we're really trying to stimulate that research in real time, because our post-implementation review is now happening much closer to the date that the standard was issued and implemented. Anne, did you want to add?
Thanks, Christine. Yes, a couple of things. So the IASB does literature reviews in its post-implementation reviews, and there have been 4 post-implementation reviews, all with literature reviews. So that's been an established step. But the other thing that's been developing as we've been working on some very large projects is having literature reviews as part of the standard setting work. And that's got a couple of benefits. To feed into the thinking and the process that's going on. But it also means when a post-implementation review is done later, there's already a benchmark established in the literature. So I think there's a lot more attention to the academic evidence for the reasons that Shannon expressed in her opening comments. A third thing that I would point out is that when we look back into the literature, when we're doing standard setting projects or indeed a post-implementation review, sometimes in the past we've found that the standard setters have questions and the research doesn't address the questions. So that is why we've engaged with this process we're talking to you today about, but also our conference for 2022. Christine's mentioned our conference, and that is specifically about encouraging research that is relevant to our projects and our post-implementation reviews. So we're trying to have a dialogue with academics through this meeting and many other meetings to encourage the research so that we'll address the issues that the standard setters want to consider in the post-implementation review. So in that way, we see it as a win-win, because the academics know more about what evidence we're looking for, and the standard setters are more likely to get that evidence. Thank you.
Thanks, Christine and Anne. We'll take this last question from RT Dennis. Sorry, my dog's in the background. RT Dennis, if you want to unmute yourself, and then after that one, we'll move on.
Thanks. I just more of a comment to the GASB/FASB. If could the studies actually be cited in the standard as opposed to the boilerplate wording that you see as for the reason of the standard in the first place? An example would be the objective of the statement is to better meet the needs of the information of the financial users by improving accounting and reporting standards. Like, that doesn't really tell us anything as to why this standard really is important. But if a study was cited, then it would be, okay, we could see exactly what you guys were looking at to base the new standard on.
So I can take a first stab at that one. Sorry, my throat's not good today. So in the basis for conclusions, we do attempt to go through and provide an overview of the reasons why the board arrived at the conclusions that they arrived at, and also why they rejected certain alternatives that were considered. And ultimately, the board decided not to go down that path. It is an overview because we don't rely on any one thing in drawing those conclusions. If you look at a big standard like the revenue standard, there was 10 years of outreach that was conducted with auditors and with preparers and with users, and looking at academic research and bringing academics actually to the board to discuss their research. And so there's an accumulation of a huge amount of knowledge that supports those ultimate decisions. Now in the basis, we can't write a basis that's 50 pages long, so it is at a very high level. But what it does strive to do is to be, to communicate the reasons for the decisions that were made, but we can't do it by pointing to any specific research study or any specific discussion that happened with this regulator or that auditor or this investor, because it's not driven by just one, or two pieces of information. It's a large volume of information. Anne, do you want to add anything?
No, I won't. I'm busy answering a question on the chat line, so I won't add anything more to your comments, Christine.
Okay.
Thank you.
All right.
All right. Yeah, we've got some questions still in the chat box, so we'll try and address those as we go. But in the interest of time, we're going to go ahead and move on to our discussion of the post-implementation review process for revenue from contracts with customers. And was it you who was going to take this section? So take it away, Anne.
Yes, Shannon, it is me. So I'll stop working in the chat box and come on and talk about the revenue standards.
And I'll just add, we're happy to stay on after too, for those of you who want to stay and ask more questions. But yeah, I just want to make sure we get through our content. So go for it, Anne.
Yeah. So the revenue standards are converged standards, the result from the convergence program that the two boards worked on. So next slide, please, Shannon. Right. So the revenue recognition model has a core principle. You can see it stated there in the slide. The principle is that to recognize revenue in a way that will capture the transfer of goods and services to customers and reflect an amount that reflects the consideration to which the entity expects to be entitled in exchange for the goods and services. So it's very important for the standard setters to have a principle to build the standard around. And because no standards can cover all situations, they must be principle based, then they can be applied in different situations as things come up. So the revenue recognition model has 5 steps, and you can see them on the slide here. No, just go back one, please, Shannon. I'm still on this slide. Okay, so the idea of the principle is something that's simple and intuitive. It clearly explains what is depicted by revenue in the accounts. And then to apply the core principle, the entity follows these 5 steps that you can see. And the steps provide a logical process for working through a revenue transaction to determine when and how much revenue to recognize. So you can see on the slides, it's about identifying the contract with the customer, identifying the performance obligations based on an assessment of the goods and services provided. The entity then determines the transaction price, which represents the total amount of revenue to be recognized over the life of the contract. And then the entity allocates the transaction price in step 3 to all the performance obligations that have been identified in step 2. Finally, revenue is recognized when or as each performance obligation is satisfied. So you can see that performance obligations are at the heart of the model. They are the parts of the contract that are accounted for separately, and therefore the way they are identified in step 2 affects both the recognition and the measurement of revenue. Next slide, please, Shannon. So what we wanted to show on this slide was that the disclosure requirements are a very important part of the standards. The standards have a disclosure objective, and that's a statement of what the aim of the disclosures are. So in this case, to enable the users to understand the nature, amount, timing, and uncertainty of revenue and cash flows related to the contracts with customers. So in terms of disclosure, there are 3 areas shown on the slides here. Firstly, standards require the entity to disaggregate revenue into categories that depict this nature, amount, timing, and uncertainty. There are examples of types of categories that might be appropriate in the standards, but entities must determine the type of category that will be useful, or category or categories that would be useful to users to reflect the entity's specific circumstances. Secondly, disclosures are required about contracts, and this includes information about contract balances and changes in them, information about performance obligations, and amounts allocated to remaining performance obligations. And thirdly, and importantly, the standards require disclosures about the significant judgments that an entity has made in applying the standards. This includes the timing and methods for recognising revenue. This very important distinction between point in time and over time revenue recognition. Also determining the transaction price and allocating amounts to performance obligations require judgment. So these are very important disclosures because the standard is built on the use of judgment as the standard is applied using the 5-step model, considering the objectives for each step and the application guidance. Going to the next slide, please. We've now got a set of slides that highlight for you ways in which researchers can approach the questions of interest to the standard setters. So when we began this presentation, Shannon talked to you about the steps of the post-implementation review and all the questions that the standard setters address. So now as we go through for revenue and the other standards we want to talk about, we're going to have these slides that list a lot of things that people could take on. So on this first slide, it's about investigating whether information is decision useful. Bear with me while I move that. Right, thank you. Now, decision usefulness. The first questions that the standard setters ask about the application of a standard is whether the standard has enabled entities to produce information that is useful for decision making. So on this list, we've got examples of things that could be investigated. So firstly, looking at financial and other impacts of the implementation of the new standard. In relation to revenue, some entities told us that the amount of revenue recognised did not change significantly, but studies can investigate the impact of the standards by considering whether the impact was as expected in a particular industry or in industries where it wasn't expected to have a significant impact and impacts were observed. So having an industry focus in the investigations can be useful. We're interested in whether the usefulness of information varies by the type of user and whether the comparability of information has improved between entities, within industries, and also in the case of the IASB, across jurisdictions. Next slide, please, Shannon. Research about disclosures can be very informative. Given the important and new disclosure requirements in the revenue standards, the boards are interested in feedback about whether the disclosure objectives in the standards are being met. So various aspects can be explored when examining how decision useful and how comparable disclosures are. For example, looking at disaggregation, the balance between quantitative and qualitative information, looking at boilerplate versus informative disclosures, and looking at disclosures about the impact of significant judgments. Next slide, please, Shannon. Another question that the boards need to address is whether the standard is operational. So there are several practical issues that can be explored in relation to implementation costs and whether the efficiency of operations has improved. The impact on contracting parties could also be examined. There was an expectation that there were many costs involved with the new requirements, and some would be non-recurring and relate to implementation. Some of the long-term expected increases in cost relate to disclosures and the audit of disclosures. They also relate to maintaining the improved systems and, for example, higher personnel costs. But the costs for users of the new standards are expected to be non-recurring. These are all questions that can be investigated. Next slide, please. On our list of questions was the matter of whether there were significant unexpected changes or consequences. One of the areas that researchers can look at is whether information used internally has changed and improved. Is there better internal communication as a result of the standard? I've already mentioned contracting. So this could be in relation to debt covenants and remuneration contracts when we look at changes in contract terms. Next slide, please. Something that's very important to the standard setters is for us to learn about the transition effects and the effects of allowing exemptions in standards. This is important because the evidence gathered can feed into the standard setters' work when they're developing new standards. So evidence about how alternative approaches to transition have affected users is very important. In addition, we know that allowing exemptions can impact upon comparability. So we like to have evidence about how that's played out in practice. This slide lists specific points that are worth considering in research. So for example, we're interested to know how companies have provided information to ensure that investors can compare the current information to prior information that was prepared under a different standard, given that comparability of information and a continuous time series of data is very important to investors. Exemptions potentially can upset the comparability of information. So evidence about the extent to which exemptions have been used and their impact on users is relevant to the future work of standard setters. Next slide, Shannon. And what we have for this slide and the next is some links to go through to relevant materials. There are a lot of materials on the FASB website and also on the IASB website. And this is material that we believe would be of great interest to academics, giving you background on the projects, on the standards. But in addition, there is specific material here that we've prepared that is for academics to guide them in their research activities. So we recommend those to you, and that's slide 22 and 23. And the next slide, it's question time again. Thanks, Shannon.
Thanks, Anne. A couple of questions that I'm gonna lump together from our last round that we didn't get to in the chat box. We had some questions about qualitative research and also some specifically about survey research. So Anne and Christine, can you maybe talk about how qualitative research done by academics would be useful in the PIR process and maybe also broadly in the standard setting process?
Yeah. We welcome all types of research. We find that we can learn something from all different approaches, and it's particularly helpful when there's research that looks at similar questions from using different approaches, so we can triangulate across research studies, and then also with our own anecdotal evidence that we collect. Specifically with respect to research that is done qualitatively by academics, I think one of the biggest advantages of that relative to what we do goes back to what Shannon said about samples. You know, we we often end up speaking to people who want to speak to us, so volunteers. And we do go out and try to identify other companies and individuals that are interested in speaking with us, but it's not the same approach to selecting a sample in an unbiased way and then analyzing the effect of any biases that might exist from sample selection on the ultimate results. It's just, you know, that's a skill set and an approach that is used in academic research to a much lesser extent to what we do internally. What we do internally is you know, we'll think about our samples and we'll infer that, well, if we're talking to a lot of large companies, let's try to talk to some small companies. And depending on where we end up on that, what are the implications of that for what we heard? But it's much more of a qualitative analysis as opposed to the type of rigorous analysis that a qualitative researcher would do based on the you know, best practices of academic research.
Shannon, if I might add on that, yes, I think at the IASB, the staff teams look very broadly at research, and they're always keen to have papers, and many papers come our way. And so it's very a broad church, if I could use that expression. It's looking for the evidence and where might that come. There have been times where we've had case studies that have provided very useful evidence. So we have an IASB research forum on an annual basis. And a couple of years ago, we had one in Sydney, and somebody presented a case study that was around financial instruments use by a particular Chinese entity. And there were a number of entities within that. And that kind of thing might not be the first thing that comes to mind because it was very specific to a country and a particular standard and a small sample of entities involved. Yet it was illustrative, and there was a great deal of interest in that paper, as there are in any papers that can address questions that are important for the standard setters. So sometimes it can even be a case study, but certainly interview evidence, because academics have the tools to construct their questionnaires properly and to access and carry out their interviews and then do their analysis. Having those skills, very important, and that's a way that we get a lot of evidence. Thank you.
Thanks, Anne and Christine. Dr. Salih, do you want to unmute yourself and ask your question? Are you out there, Dr. Salih? And maybe I'm pronouncing your name wrong. Salih.
Hello.
Yep, we can hear you now.
You hear me?
Yes, we can hear you.
Okay. Thank you very much for the excellent and informative presentation. I'm Dr. Saleh. I'm speaking from Sudan. And I have one or two comments. First, regarding the IOFI, which is an organization that sets standards for Islamic financial industry, for takaful, for banking and capital markets, something like this. Do you have any cooperation between the international accounting standards with the IOFI, which is to some extent an early emerged or established in relation to IAS or FASB or something like this? What sort of coordination or cooperation that might exist? You know that IOFI has set so many standards in different areas of Islamic finance and business, and now widely recognized even in Western countries, not only in the Muslim countries. This is one. Second,
no, let Dr. Saleh, let me do that one first, and then you can do your second one. Yes, so we're aware of the standards that have been written for Islamic financial practices, and so you would know about the group, the Asia-Oceania Standard Setters Group, and within that Asia-Oceania Standard Setters Group, there is an Islamic finance group within that, because in the Asia-Oceania region, we have Malaysia, and so there's great interest in Islamic finance. So within that group of standard setters, which represents several countries in the IFRS world, there is a dedicated Islamic finance group. And so the IASB gets to talk to them at various times. So the information, there is exchange of information, and there is awareness of the work of the group you're talking about. So thank you for your question, and I'll hand back to you for your second question now.
Okay, good, very excellent reply. Second is about, is there any another factors that influence standard setting other than academic research? I mean, from the regulatory perspective, sometimes parliamentary or governmental originated issues, something like this, other than academic research.
Yes, there are many factors that impact on standard setting, and that's true for FASB and the IASB. You mentioned regulators. So there's work, there's conversations going on regularly between the standard setters and the regulators. And that might be a securities market regulator like the SEC, or the regulators in the countries of the IFRS world. It might be banking regulators when we're working on financial instrument standards, which we're going to talk about tonight. So there are constant dialogues going on between the standard setters and various groups of interested parties. So it's not that we, as if we only talk to preparers, the companies, it's not that we just talk to them. We're also in interactions with the audit firms. Very important user group is the users of the financial information, so investors. And we have, both boards have a range of ways we interact with stakeholders. Because there are many, the standards, there are many factors to consider, many groups to consider when we're developing standards. So thank you. Thank you for your questions.
Last question.
No. Okay, one more quickly. Thank you.
One more quickly, okay. Last about the quality of the standard setting. Who will assess? I mean, the international, the IAS or FSAB or whatever, the international organizations that set the standards. Who will oversee the quality of the work? The practitioners, I mean the feedback that comes, or there is a supervision over them?
The operations of the board, there are foundations that oversee the board. So in the IFRS world, there's the trustees. In the FASB, there's the FAF, the Financial Accounting Foundation. So the boards are independent standard setters, but there are the foundations. There's other bodies that deal with stakeholders. So there is that oversight that goes on. In terms of assessing who is it that assesses standards, whether they're effective or not, well, that's going to stand the test of time. And it's going to be the capital markets and all the stakeholders who assess whether the standards, have they been fit for purpose. So we're talking to you today about post-implementation reviews and the process that we go through. But that is just one part of it. There's a much more medium to long-term assessment on standards. And I think many parties, including academics, are involved in that. Now, I'll stop talking and thank you for your questions. I'm going to hand back to, thank you. I'm going to hand back to Shannon because I can see other hands up as well. Thank you.
Thanks, Anne. Yeah, we'll take this question from John if you want to unmute yourself, and then we'll move forward with the presentation after that.
Sure. I wonder whether the IASB and FASB think about creating their own research outlet. some of the research questions that Anne talked about related to revenue recognition are descriptive nature, which is probably could be important part of some bigger empirical project, but itself couldn't be published in the top academic journals. So, instead of finding the overlap between the academics and the standard setters, if the standard setters have their own research outlet, it may be a blog or something else, that academic, right, can answer these questions and submit it to the standard setter directly, right? So, both of you seem like have some former editorial experience that are going to be helpful for academic to try to write on a more timely topic instead of, suffer the long research lag. Thank you.
Thanks, John. I'll just add that we definitely welcome the submission of research at any point in the process. And so we don't just look at published papers, we absolutely consider working papers, and that's where we go for timely information. And there's been several times during just my year at the FASB, and I'm sure it's happened prior to that and happens at the IASB as well, where we connect the staff with academics to talk about some of those more descriptive things. So we find a study that seems relevant, and then we have phone calls and we talk about more of the descriptive statistics that maybe don't make it into the paper. And I know the staff really value that feedback and getting that information from academics. They've been very appreciative of those calls, but absolutely we can consider other outlets that we might be able to create for academics to share their work with us. Yeah, I don't know, Anne or Christine, if there's anything you want to add. Otherwise, Christine, if you want to get going on the next section.
Sounds good. I will just add one thing, and that is that, we are working internally to continuously improve our approach to collecting the type of data that we collect internally. We talked a lot about the in-depth interviewing that we do, but we also have the XBRL team in-house. And so often our staff will reach out to the XBRL team and ask them to collect data, to at least do the descriptive analysis to help us get a lay of the land. Just as an example, in our current expected credit loss post-implementation review, our XBRL team immediately went into action and started collecting data as it started to come out in that first quarter of 2020, and did a lot of cleaning of the data and analysis for us so that we could get our hands around, what was the impact on the size of the allowance, and how does that break down across big companies and small companies. So we do some of that descriptive analysis in-house as well. And having our postdoc fellow on staff has just been invaluable to the teams and to researchers, I think, because Shannon in her role acts as a liaison between our organization and the academic community, and it's been very successful in bringing research to our staff teams in a systematic way, and build those connections, which has been really helpful. So kudos to our postdoc fellows. Shannon's actually going to be finishing her term as postdoc fellow in a few weeks, and our new postdoc fellow, Tanya Paul from Wharton, is going to be, has already joined us and is actually shadowing Shannon for the next couple of weeks. So, all right, if we can go to the next slide, we're going to move on to the lease standard. Excuse me, I have to apologize for my voice today. I think I heard it yesterday because I'm actually in the mountains of Utah, and there was a moose on my driveway that my dog went after, and I screamed at him, and I think I actually screamed so hard I damaged my vocal cords. So I'm going to be clearing my throat a little bit more than normal. I apologize for that. All right, on to the LISA standard. So the core principle that underlies this standard is that a lease conveys a right to use an asset for a period of time in exchange for consideration, and that right of use does meet the definition of an asset And if the payments for that right of use are made over time, the obligation to make those payments does meet the definition of a liability. And so for lease contracts to be faithfully represented in the financial statements, both that asset and that liability need to be reflected on the entity's balance sheet. We can go to the next slide. Thanks, Shannon. So the new standards require balance sheet presentation of the right of use asset and the lease liability for all contracts that meet the definition of a lease. So it used to be that the mechanism that drove balance sheet presentation was the classification. Was it an operating lease? Okay, it's off balance sheet. Is it a capital lease? Okay, it's on balance sheet. So it was that classification of the lease. Now it's the definition of a lease that drives the requirement to present something in the financial statements. Now, under US GAAP, there does continue to be an important difference between leases that are classified as finance leases and leases that are classified as operating leases when it comes to presentation of the information on the income statement and the cash flow statement. And that's an important area of difference between US Topic 842 and IFRS 16, because as I'm sure you all know, IFRS 16 has a single classification model, and that classification is consistent with the finance lease treatment. So next slide. Thanks, Shannon. So within US GAAP, there are still factors that companies consider to determine whether a lease is classified as operating or financing. And these factors are quite similar to the factors that were in the previous topic 840 and were used to distinguish capital leases from operating leases. So when you hear finance lease, think capital lease, because it's very similar to that old previous notion of a capital lease. There has been the addition of one factor though, and I circled it in green on this slide. And that additional factor is that a lease is classified as a finance lease if the underlying asset is of such a specialized nature that there is not an alternative use for that asset by the lessor when the lease term ends. So that's another characteristic that companies will take into consideration in determining whether a lease should be treated as a finance lease or treated as an operating lease. So like Anne was talking about, it's typical for the disclosure requirements to start with a stated objective to help companies and auditors and users of financial information just have an understanding of what the purpose of the disclosures are, so that they can ensure that the information they're providing is achieving that objective. So the objective in this case is to help users of financial statements assess the amount, timing, and uncertainty of the cash flows that are arising from their lease contracts. And there are qualitative disclosure requirements, and there are disclosure requirements that are quantitative in nature as well. So it's a mixture of qualitative and quantitative information that companies are required to provide to the users of financial statements. The qualitative disclosures include things like the nature of the leases, some information about leases that have not yet commenced, but actually do represent significant rights and obligations to the company, significant assumptions and judgments that management made in applying the lease standard. So all of those are examples of the qualitative types of disclosures. And then in terms of quantitative disclosures, companies are required to disclose their lease expense, and they need to disaggregate that expense between the component that is amortization expense, the component that is interest expense. And in the US, they also have to disaggregate between the finance lease expense and the operating lease expense. Some other examples of the types of quantitative disclosures that the companies must provide would be things like the weighted average remaining term on the lease, because that's a pretty important assumption that is made. The weighted average discount rate, another important assumption. So quantitative information to help users understand those assumptions that companies have made. And then a lease payment maturity analysis to provide some insight into the timing of the future payments. Next slide. So through the post-implementation review of this standard, once again, we're trying to understand whether the information that is being presented in the financial statements is decision useful to investors. So is the information about the lease asset and the lease liability useful to them? And does the usefulness of the information differ by type of user? So for example, anecdotally, we've heard that equity investors are quite happy with the operating lease model because they're focused on the cash flows that are associated that are arising from the lease contracts. Credit analysts and credit investors, however, they prefer the finance lease model because they're focused on solvency and they view these contracts as a financing arrangement. And so they prefer to see the leases all under operating lease treatment. And so they'll make adjustments using the information in the footnotes to get to a single finance lease model. We've also heard from investors that are more focused on return on investment analysis, that they actually don't like the focus on the contract term. They instead prefer to analyze the assets and the obligations based on a life of asset concept. And so what they'll sometimes do is remove the information and then use the information that's in the footnotes to replace it with an asset and liability that reflects what they perceive to be the life of the asset. And sometimes they'll do that using a rule of thumb of like 7 or 8 times operating lease payments, which is the way that they perform the analysis before the new standard came into effect. Next slide. So we're also interested in how the information that investors get today compares with the information that they received in the footnotes prior to the requirement to capitalize. And we're also interested in the disclosures and how investors are using the information in the disclosures to compare across companies, to understand the information that's in the financial statements, and also potentially to adjust that information in ways that I was just describing. Now, since this standard is only partially converged, we also are seeking to understand whether the decision usefulness of the information varies between the FASB dual classification model and the IASB single classification model, how having those different approaches affects comparability, if it does or doesn't, because it kind of depends on where you are in the lease term as to whether or not it creates significant differences. And whether the information provided by the dual model versus the single model, whether that information and the usefulness of it and use of it varies by type of user. So those are all questions that we're interested in there. We're also interested in understanding the operationality of the standard. So take a significant judgment that companies apply in this realm, the discount rate. Are those discount rate assumptions comparable across companies where you would expect them to be comparable across companies? Do those assumptions in an unbiased way reflect the underlying economics of the company? And we're also interested in how investors are impacted by those judgments. So are there operational challenges that are created for preparers, for auditors, and for investors as a result of the judgment that is included or required by the standard. I'm getting a notice that my internet is unstable. Is that affecting you on your end?
We're
Am I
okay,
still
Christine.
good? Okay. Sorry about that. One of the disadvantages of being at 8,500 feet above sea level. All right. So we're also interested in whether there have been significant unexpected changes or consequences as a result of the standard. So here, has the adoption of the standard impacted lease contracting behavior, the specifics of lease contracts? Has there been a change in the efficiency of asset utilization? We're aware of at least one study that has looked at that issue. So that's something that we're quite interested in understanding. And then also the efficiency of lease contracting, at the requirement to move the information from the footnotes to the balance sheet, the income statement, and the cash flow statement resulted in the collection and the addition of processes around lease contracting that has created a lot more information for internal use to ensure that leasing is being managed in an effective way. Next slide. So here again are links to relevant materials on the FASB website. In a moment, we'll see some links to materials on the IASB website. That link is to an academic webinar that the IASB did that delves into even more detail on the types of questions that the IASB is interested in understanding through post-implementation review. And if we can go back just to the previous slide for a moment. You'll notice that there's a link to an FASB webinar that was similar that we conducted, and the slides that were used in that webinar. The other link that I just want to point to on this slide is the one that's entitled Relevant Project Files. So under Shannon's leadership, we had the staff go through and put together a file of all of the public documents that were related to the development of the lease standard, the revenue standard, and the CECL standard, and put those all in one place in a zip file and post a link to that file on our website. So with one click, you can download tons of documents that you might otherwise have had to go through and pick off of our website in a less efficient way. So I think that brings us to Q&A again.
Yeah, and it doesn't look like we have any questions. And in the interest of time, I'm going to keep us moving forward just so that we can make sure we get through all the content. And then again, we'll circle back to more questions at the end. So we're going to move on to the credit losses standard, starting with you again, Christine. Is that correct?
Yes, that's correct. Thanks, Shannon. So before I delve right into the model, I think it's important to review again why it was that standard setters undertook this project. And this chart presents the loan loss reserves as a percentage of gross loans outstanding over the last 7 decades. Now, in the US, the incurred loss model of accounting for credit losses had been in place since 1975. And that came into being with the issuance of FAS5, which introduced the probable threshold for determining when a loan loss provision needed to be established. Adhering to that probable threshold that's in FAS5 resulted in the delayed recognition of loan losses until it was well established that they existed. So kind of at the end of the life of the loan. And we can see from this graph that both in the 1970s and again in the 2004 to 2006 time period, you see where loan loss reserves were at all-time lows, multi-decade lows, right before we went into a banking crisis, into a financial crisis. And in the most recent example of that, in the financial crisis of 2008, what we were hearing in real time from banks and from investors was that adherence to that probable threshold was resulting in loan loss provisioning lagging behind where everybody understood, based on what they were observing happening in the marketplace in real time, that those loan loss provisions were lagging in terms of timeliness of information, that adherence, that requirement to adhere to the probable threshold, resulted in forward-looking information not being incorporated into the provision for loan losses in a timely way. So after the crisis happened, the FASB and the IASB formed a financial crisis advisory group, and that group confirmed that view. They recommended that loan loss provisioning be done in a way that allowed for forward-looking information to be incorporated into the provision. Now, the FASB and the IASB worked on this project together, considered a number of different approaches to coming up with standards for estimating expected credit losses. And ultimately, based on a differential analysis of cost benefit, because we're operating in different, environments, decided to go a different way in terms of the final solution. So I'm just going to talk now about where the FASB ended up, and then Anne can speak to where the IASB ended up. So ultimately, the FASB ended up in the current expected credit loss approach. And the single biggest difference between the CECL model and the old incurred loss model was the elimination of that probable threshold. So this slide, that equation that you see on this slide, just lays out how an entity goes about determining expected credit losses and determining the allowance under the expected credit loss model. So A is amortized cost. That represents the amount that was lent and is the gross amount that is reported on the balance sheet. And then C represents the amount that the management actually expects to collect. So the difference between the amount they expect to collect, which is the net amount that is represented in the financial statements on the balance sheet under the CECL model, and the amount that was lent, the amortized cost, that difference is the allowance for credit losses, or B. So what I'm describing is basically what companies have done with respect to their trade receivables for years. It's the way I would have described to my students when I was a faculty member how a company should go about determining their allowance for credit losses. I'd say, well, what's the amount that you lent in terms of a trade receivable? What do you expect to collect? And the difference should be the allowance. And in determining the amount that you expect to collect, look at your past history, think about what you can understand from the past for your future ability to collect, and then consider the current environment and what changes might have happened that might cause the past not to be informative of the future, and adjust your estimates to take into consideration those changes in the environment. And that's essentially what the CECL model does. As a result, we wouldn't have expected the application of the CECL model to really change what was happening with respect to trade receivables, because they've always been under that sort of current expected credit loss methodology. And in fact, that's what we're observing now that the standard has been implemented. So the big change, of course, was in the banking industry and the finance industry, where they were under a very different incurred loss type model. The other thing I'll say, just one last thing on this slide before we move on to the effective dates, is just if you think logically about when the allowance for credit losses can be established, there's really only three logical places in time, right? You can wait until the end, and you know that a loan has gone bad, and you can record the allowance at that point. That is the incurred loss model. And what we heard was that, that information, while, useful, is not timely. It's received after, after the bad thing has sort of already happened. You could try to determine the allowance over the life of the contract while the credit is changing, as it deteriorates over time. But it doesn't happen in equal increments over time. It often happens in response to, specific situations arising. If you take a mortgage, somebody gets a divorce, somebody loses their job. Those sorts of events are what causes the decline in credit quality. And it's very hard to come up with an approach that is sort of going to match the timing of the credit impairment being recorded to the actual event that gives rise to the decline in credit impairment. So the boards did look to approaches that would try to match the timing over time as credit deteriorated. The FASB ultimately concluded that there wasn't a way that was going to work well within the US environment to do that. So the last alternative is to record the estimate of the credit, the future credit losses at the time that the contract is initiated. And that essentially is the CECL model. So if we can move on now to the next slide. So the CECL guidance was effective January 2020 for most calendar year companies that are public business entities, except for SEC filers that are classified as smaller reporting companies. For the SRCs, the smaller reporting companies and all other entities, the guidance is going to be effective starting in January 2023. Now, that's what's in the guidance, but you may be aware that in March of 2020, Congress issued the CARES Act and provided public companies with an optional deferral of the application of CECL until the earlier of December 31, 2020, or the date on which the national emergency concerning COVID-19 terminated. Next slide. 43 small to mid-sized financial institutions decided to take that optional deferral that was provided for in the CARES Act. But 157 companies, financial institutions, representing the vast majority of assets in the system, decided to go ahead and adopt CECL in 2020 as planned. Now, after that point in time, then in January of 2021, the Appropriations Act of 2021 was passed by Congress, and that act provided for an extension of the CECL relief to January 1, 2022, or the first day of the fiscal year that begins after the date on which the emergency is deemed over. Of the 43 entities that took that first deferral, only 10 decided to take the second deferral. So I think there's some interesting questions about, well, why did certain companies take the deferral? Why did others not take the deferral? Why did the companies that didn't take the second deferral but did take the first deferral ultimately make that decision, and so forth? All right. And in terms of the disclosures that are required, the objective here is to help investors, help users understand the credit risk that's inherent in the portfolio and how management monitors that credit quality and manages the credit quality of their portfolio, as well as the initial and ongoing estimates of credit losses. Now, there's a whole bunch of disclosures that are required, and we've heard a lot of positive feedback from investors regarding the improvement in disclosures. They really like the loan vintage disclosures disaggregated by credit quality indicators as one example, the allowance roll forward. Those are all very well received. But we have heard concerns by some investors that they're not getting enough quantitative information and qualitative information to really help them understand management's estimates of expected credit losses. So that's an area that we're looking at pretty closely. Next slide. So in terms of questions, the overarching question is whether CECL provides users with better information about expected credit losses than the incurred loss model did, and whether the comparability of information is different under the old incurred loss model versus the new expected credit loss model. We're also interested in whether there's evidence to support or refute that anecdotal evidence that we're hearing about the disclosures and the extent to which investors are finding those disclosures adequate to understand the provision for loan losses, and then also to compare across companies. In terms of operationality of the standard, this is one where, again, there's quite a bit of judgment, because if you're asking management forecast your future losses, obviously there's a lot of judgment that is going to come into play in coming up with that estimate. And so, we're interested in the impact of requiring that judgment on the operationality of the standard for preparers and for auditors and for investors, and the extent to which the flexibility within the standard to choose inputs and to choose approaches in order to try to get to the same measurement attribute, which is your best estimate of what you think you're going to collect at the end of the day, whether that judgment is reflecting the underlying economics for entities. We're also interested, again, in unexpected changes or consequences or results of the standard. And this one is unique because of the interplay between accounting and regulatory capital requirements. So any research that helps us to understand how those two things are working together to impact bank lending practices, their practices for retaining capital, like stock buybacks or dividend payments, all of that is something that we're very interested in understanding as well. And finally, this was is I think the first standard where we've had staggered adoption between large and small public companies. And then there's the added wrinkle of the CARES Act in there as well. So we're really interested in research that helps us to understand the choices that companies made. Were those choices systematic? And if so, what were the factors that seem to drive those choices? And how were investors and how is the comparability of information impacted by the staggering of effective dates? That will help us to do a better job on a go-forward basis as we think about how to best set effective dates in order to get a reasonable balance between cost and the benefit of the information. And here we just, again, have the links to the useful materials, hopefully useful materials on the FASB and IASB websites. And I think that takes us to Anne, who is now going to talk about IFRS 9, their financial instrument standard.
Thanks, Christine. So just a few slides here to give you a taste and flavor of the things that are different from the FASB standard. Prior to these recent changes, the standard in the IASB standard was IAS 39, and that was very close to the FASB standards. But now there are some differences. In relation to IFRS 9, the post-implementation review that we have open is about classification and measurement. So what you can see on the slide here is the basis of our classification model. So I'll just briefly say a few words about this, and then I'll talk about impairment so that we can follow on from Christine discussing the CECL model. So just a couple of things here. So our PIR is about classification and measurement. We are interested in research on that topic. If you look at this chart or diagram in front of you, the approach to classification of financial assets is based on the business model and the nature of cash flows. So for example, if the business model of the bank was hold to collect and the cash flows involved were solely payments of principal and interest, the measurement would be amortized cost. So this gives you a view of the measurement that comes from looking at business model and the nature of the cash flows. In classification and measurement in IFRS 9, the IASB has allowed an election in relation to a business model for hold to collect and sell. It's in relation to equity securities, and there is an irrevocable option around fair value OCI. Now, this reflects that under IAS 39, there was a category called available for sale investments, and people made use of that category. Now, that category doesn't exist anymore, and it does not exist in the FASB standard. However, there is an election that people can use. So if we just go to the next slide, I just want to explain this as a research opportunity. So there is no longer an available for sale category for equity instruments, so for equity investments. However, there's an irrevocable election, there's no impairment on it, and there is no recycling. And we're very interested to hear the feedback from research about the use of this category. There are some people that would like this category to come back, the available for sale category to come back, and there are others who are adamant that the available for sale category was an earnings management tool. And indeed, as I've said, it doesn't exist in the FASB standards. So research that can help us make decisions about any changes to the standards would be particularly helpful. So next slide, please, Shannon. Christine's told us about the CECL model, and the development of the ECL model for the IASB reflected those pressures and concerns that were in the marketplace around the time of the financial crisis. So if we look at the list on here on this slide of the benefits that were expected to come from the ECL model, this list leads directly into research that people can do. So for example, the use of an expected loss model should lead to more timely recognition of expected credit losses, so research can investigate whether that indeed has happened. In the longer term, there's questions about financial stability, and they can be investigated, but not. There needs some more data to be accumulated before that can happen. There are enhanced disclosures in IFRS 9, and so once again, research that investigates disclosures would be useful. Now, just bear with me 1 minute while I open this file. Okay, could we go to slide 54, please? This is a pictorial representation of the ECL model, and it is a different model to the one Christine described. If you'd like to know more about this model, please have a look at the materials on our website. You can find them through the IFRS 9 page, you can find them through the academic page, or indeed the links that we've included in this presentation. Now, although the model is different, the reasons behind introducing this new model were very similar, and indeed the way to investigate this model and to look at the impact of the model are also similar to many of the things that Christine's mentioned. So next slide, please, Shannon. So here's just a list of some things that we're interested in having evidence about. So in relation to an ECL model, the impact on reported numbers and financial ratios, how the calculations capture the underlying economics, Where's the differences between entities and industries and countries? The mention of financial stability here. So does the better measurement of impairment contribute to the broader social goals that were part of consideration of this change? There are disclosure requirements in IFRS 7 in relation to the ECL model. And a few times today, we've mentioned the importance of disclosure and how that's a very rich area for research. And this is true for the ECL model as well. And I won't repeat what's on the slide, but in this slide and throughout this slide deck and in our other presentations, we've provided lots of leads into what would be relevant research for us about disclosure. So next slide, please. And this is the link to get the additional information on IFRS 9 and indeed IFRS 16. So I'll stop there and we can have some questions. Thank you, Shannon.
I'm going to take us through the last couple slides and then we'll open it up to any final questions that we might have before we close for the day. So one of the questions I saw in the chat box was about what resources, both financial and non-financial, the FASB and IASB are providing to academics interested in conducting research related to the PIR process. The links that we have throughout provide a lot of great information in terms of non-financial support. So as both Anne and Christine mentioned, the FASB and IASB conducted detailed webinars that provide great information for academics looking to do research in these areas. The FASB is also hosting a webinar on July 13th. For anyone interested in learning more about XBRL data, this webinar will teach you how you can pull XBRL data for use in your research and include some hands-on examples using the revenue setting. So if you're interested in learning more about how to use XBRL data, we definitely recommend that you check this one out. And then we also wanted to highlight the academic fellow and academic on staff at the IASB's emails. So you can reach the FASB's academic fellow at academics@fasb.org. And you can reach the IASB's academic at asimpson@ifrs.org. So in the event that you have any questions or there are ways that you can think of that the FASB and IASB can continue to support academic research efforts, please reach out to us. We'd love to hear from you. And with that, we'll end with any final questions that we have. Hop to our chat here. See.
So I think we're out of time.
Shannon, okay. Can I quickly answer Victoria?
Yeah, so what I was just going to say was maybe we can just say goodbye to anybody who has to leave, but I know I'm perfectly happy to stick around and answer some additional questions. And I know it's getting late with you, but I know everybody would love to have you stay as long as you're able. So anyway, if you want to go ahead, Anne.
Okay, great, thanks. I was going to answer to Victoria, who asked about the PIR for hedge accounting, so spot on. There were changes in hedge requirements in IFRS 9, but many banks are still using IAS 39, and that's because of the macro hedging project. So you're quite right, we won't be conducting our post-implementation review on hedging as yet. Thank you.
Thank you.
I don't think I see any other questions. So thank you again to everyone for tuning in today. We really appreciated having the opportunity to share this information with you. And thank you to Mohamed for the invitation. It was a pleasure.
Thank you very much, dear Professor Christine, Professor Anna, Dr. Shannon. Thank you very much for this really an excellent presentation. Thank you very much. So all, thank you very. It remains for me to say is thank you everyone that's joined us, and I thank you very much for taking the time out to present to us today, dear Professor Christine, Professor Anna, Professor Shannon. It's been really appreciated. Thank you very much.
Thank you.
Thank you, Mohamed. Thank you, everyone.